Hi, I'm Christian Maloof and welcome back to our weekly update for Capital Clarity. Please note, once again, this is not financial advice. This is purely just an economic update under the lens of myself and sharing with you my thoughts and how I'm approaching the markets this week, starting Monday, the 30th of March, 2026. So we'll start with some news. We've got a bit of an AI overview here from Google. The global economy is facing significant volatility due to the escalating Iran conflict, driving up oil prices and causing widespread market uncertainty. And I think if you had to cover what's going on in the world right now, that sentence probably covers it quite well. The main worry for everybody at this point in time is the ever escalating prices and availability of oil. We know that oil runs everything in terms of fuel and how goods and services are transported across the economy, across the world economy. And having the Strait of Hormuz blocked by Iran at this point in time, we're finding that oil is beginning to run out, for lack of a better way of putting it. And we're even seeing things over here in Australia at the moment where there's certain fuel stations now saying they've run out of fuel, which is quite interesting and causing a little bit of panic locally. And it is a serious concern that the longer the conflict goes and the more oil assets are taken out based on the war, and the longer that oil isn't able to get out of the Middle East, that we're going to see a real issue within the economy, both in terms of the cost of everything, but also in terms of people actually even being able to get around based on not being able to get any fuel. For those Tesla drivers out there and those EV drivers out there, they're feeling probably a little bit less concerned, but still being impacted in terms of costs of things, with inflation now starting to climb again, or anticipated to be starting to climb again. We're going to see the need potentially for interest rate rises, and we've already seen a couple of interest rate increases here in Australia. We haven't seen that in other parts of the world yet. But I believe that if things do continue on the current course, that could very well be on the table, and that will absolutely impact the marketplace. With that all being said, the update for Monday is that nothing's changed in terms of the conflict going over there in the Middle East. Everything's continuing as it has been, albeit we're not at a point where America has entered into ground war or entered with troops into the Middle East at this point in time. However, I would say tensions are still high, and we're in a position where that's really causing a lot of uncertainty in the marketplace. So if I do give a quick sort of summary of the main charts here in the market at the moment, I'll start with the oil chart, actually. I think the oil chart's probably a good one to have a look at. This morning in early trade in Australia, we've seen the price of oil as high as 103-ish for futures, and that is alarming. That 100 level is the one that we've got drawn here as resistance. We haven't seen a daily close above that since the conflict started in the Middle East. We have seen it start above that day, that $100 futures price for crude oil. It is starting to come down a little bit, which is a little bit reassuring, but not until we see what happens with the day, including the American session that'll happen whilst we're asleep here in Australia. I'll keep an eye on that. But if we do get above that 100 and hold, that's only going to cause markets even more uncertainty, anxiety, stress, whatever you want to call it. And we could see some further drops across the board in other areas, including the share market and gold. So we'll keep an eye on that. But at this point in time in early trading, we are above that $100 line, and albeit stabilizing and coming down a little bit from that level, it's not looking great. So if I go to the American dollar to start, or the American futures chart, we can see that we are actually at an area of resistance, that 100 mark. Once again, like the oil chart, we're at 100. On the DXY, we're at 100. It's an area of resistance at this point in time. It has been for quite some time. We haven't been above that amount since May last year, and we have tried a few times to get above it. We haven't been able to do that. So we're once again there. Probably a little bit of weakness in the American dollar at the moment, but there's plenty of demand starting in this area of about 98 cents. I actually do think that even if we do have a little bit of that cooling and it coming down to those levels, I think we'll have some strong support at those levels. And I think the American dollar in the fullness of time could very well break that 100 mark and find its way up to the 102 area here, which is probably your next area of supply and where that'll get tested in terms of whether the bulls can continue the American dollar going up. With things going on the way that they are, and really we're starting to look at a risk off environment, that will fare well for the American dollar over the long run. And I would think that it can continue to climb in due course once it does break that 100 key level. If we're having a look at the euro, polar opposite there to the US, 114 to 114.8 mark is that sort of same as the 100 mark in the US, just obviously on the support side now. If that support is broken, we could see that continue down to the 112 number there. So I'm keeping my eye on that. Obviously, whatever the US dollar does, the euro will do the opposite in terms of their relationship and how they run off one another. So I'm keeping an eye on that support level at the moment. If that breaks, it'd be very likely the 100 mark resistance in the US dollar will break. And I don't think it's a matter of if, it's more a matter of when, even if we get some short-term weakness in the American dollar in early doors of trading this week. I did have a trade set on this in the last update I gave you. Unfortunately, I didn't get triggered on that trade based on the fact that the euro didn't rise enough to trigger me in, and it did have a significant drop from that level. So I was, from memory, I was sitting here in this little area here in my last update, and it has been 2 weeks since my last update because I was away overseas. We came down, we came back up, we almost triggered, and then we pushed back down. So that would have been a winning trade had I been triggered, but where I was getting in here on this wick over wick daily supply area, I didn't get triggered. That trade has now been taken off in terms of my ordering system, and I am actually going to wait for a higher level up here at that 118.230 level, just above the gap. So I won't set the trade at this point in time. It's too far away in terms of where price is, but there is an alert set there should we get close, and that would probably be what my trade would look like, or I'd even be willing to hold it if we did get back down to these levels and I got triggered to this level down here, 112 that I was speaking about earlier, this just little area here. You can see on the weekly chart on the left that I've got highlighted as a weekly demand zone. The Aussie dollar we've been speaking about a lot, and I spoke many times around this level between 71,530 and 72,995 as being an area of significant supply. And reading what was going on in the COT data, it was telling us that commercials were very bearish, the Aussie dollar, retail very bullish, and funds were still quite bullish. And so I was waiting for funds to roll over as a sign that we were going to be on the way back down again, albeit the COT positioning looking very weak for the Australian dollar. We obviously didn't break that area of supply we spoke about. We sort of stick right into it, and we've come back down ever since. And the area that was sort of holding as support at about 69.5 has now been broken and hurled as early as late last week. So that is very bearish for the Australian dollar. COT in terms of the funds and the smart money was actually slightly up. So there's still a little bit of economic strength in the Australian dollar. A tool that I've been using that I haven't shared with you as yet is the Edge Finder that does share macro information, and it puts it all together on a page for me. So I really like using it. And if I have a look at Edge Finder, you can check the Aussie dollar on Edge Finder in our top setups page, and it still sits at a -4 or a neutral reading. So it's not massively weak on the macro side. It's not massively strong on the macro side at the moment, but in previous weeks, it's been very strong. And that has explained a lot of the strength in the Australian dollar. It's obviously weakening, but not at a point where I would say that it's going to absolutely tank down. It's definitely been weaker, and price action, our weekly candle last week was a strong bearish candle, and we have come down to an area where really the next support is until 67,680. We have broken that old area of support that had been support since January. So look, things aren't looking great for the Australian dollar. Macro side is starting to diminish a bit, and we've obviously also broken key support. My thoughts on the Australian dollar is we may get a run back up, and if we do, I want to short it, and I will be shorting the Australian dollar now. I'm comfortable based on where things are at, that the way forward is short. However, we're not in an area at the moment where I would like to get in. And if I was going to get in, it'd be more around this sort of 69,890 value, which is an area of supply. But let's see, there is no area of demand or support here for now. So the Aussie dollar could continue to go down until it finds this area down here around 67,680. And if it does spike back up into this area of supply at 69,890, I'd be willing to jump on board for a short, provided everything else looks okay in terms of our macro situation. So I'll keep you up to date on that, but that is definitely a trade idea that I have for the moment. And the Aussie dollar is starting to show that weakness that we were anticipating over the last few weeks. We're starting to see that now materialize in terms of price action. New Zealand dollar, very similar, albeit on the New Zealand chart, we've actually reached an area of supply. On the edge finder for macro for New Zealand, New Zealand's actually extremely weak, and I'll share that quickly now. You can see here the New Zealand dollar is actually the lowest on the edge finder versus the US dollar at a -12 macro score. So when we look at that, the Kiwi's very weak. We have hit an area, a really strong area of supply on the chart. We haven't reacted from that as yet. And I think what would explain that is a really weak macro data that's coming through in terms of your fundamental data from the New Zealand economy. So if this area does break before we get any sort of bounce, we could see the New Zealand dollar go as low as 56.355 before it hits any more demand or support there. Things not looking great for the Kiwi either, especially in a risk-off environment. And if I have a look at the Kiwi, I definitely would love to be in that on a short, but I wouldn't get in again until I've got a 4-hour zone marked here on the chart. So we've got a little area just up here around 58.720 that I would be willing to jump in and have a trade. So I'm going to wait and see if we do react off this zone that we're in at the moment and come back up. If we do come back up on the Kiwi, I'll definitely be keen to short it at these levels, but won't just jump in where things are at right now. So that's the Kiwi dollar. Just quickly, what I'll do is I'll just run into the indices. The indices are quite interesting. We spoke a couple of weeks back around this sort of key level here on the ASX or on the ASX 200 of 8.5, let's say 7. We have now broken that level. And I was anticipating that we would get a bit of a correction, maybe upwards of around 16%. We're obviously well on the way to that. We're about halfway. There is a bit of demand in between. There are levels of support in between. I'm not saying that any of that's definitely going to happen. It was just a thesis in terms of what I was thinking based on what I'm seeing in the environment that we're in, but also in the price action. We've been in a distribution for a fairly long time. The market's very extended, and some of the macro was telling me that we could see a bit of a fall off. And then that's what we have seen, obviously triggered by what's going on in the economy around oil prices, inflation, and the conflict in the Middle East. So all those things have definitely helped my thesis in terms of the market moving down. I am still bearish. I'll continue to be bearish until things change in terms of our inflation outlook, cost of oil, the conflict in Iran. If those things all start changing very quickly, then I would change my bias. But for now, I would be bearish on the SX and the under indices, which I'll cover in a moment. I'm awaiting. I've got a very strong downward move here on Monday, the 9th of March. That came from a zone here around 8839. So my thoughts would be if we can get back up into that area, I would be shorting back down on the ASX. I've got a trigger in there and I'll wait and see if that happens. Very similar on the S&P. The S&P I have been looking at for a while. I had a zone marked on the S&P, which for some reason has disappeared. So I'm just going to remark that zone. It was support. I'm now viewing it as resistance. And I had a little guy there. That was an area, a key level that I thought if we did break, that would sound the alarm for some bearish activity towards the S&P, at least down to these little levels at the 6020 mark. We're obviously on our way back down there. We've broken and held that level now to the downside, and I'm just awaiting to see what happens for this week. I'm still very bearish on the indices. Interestingly enough, the Edge Finder is actually reading the indices as neutral, or some of the indices as neutral at the moment. I'll see if I'll jump into our asset scorecard here and give you a better view. But if I look at the S&P 500, Edge Finder's score at the moment is a +2. That's a neutral score. At the moment, I wouldn't be in a trade, but I do have an area of supply, very nice area of supply here marked out on that chart at a 616 level. If we get up and Edge Finder is neutral or below neutral, I would jump in on a trade there to the downside. And we've got a similar sort of setup here on the Dow Jones, similar sort of level. I would still be bearish on the Dow, and actually Edgefinder is bearish on the Dow and the Nasdaq at the moment as well. Same thing on the Nasdaq. Once again, this level is pretty similar across all charts. We have broken key areas of support on all of these indices, and so my thoughts on the indices is definitely bearish. Something I did want to point out to everybody was, everyone will remember that I was in a Dow Jones trade, the last update that I did, and that was this trade here that you can see. I was obviously activated in on the trade, almost got stopped out. You can see the candle went right up towards my stop loss, came back down, and I actually exited on, I think it was Friday the 10th of March. I exited, no, 13th of March, Friday the 13th of March, I exited that night. I was worried about the weekend. Obviously, we're in a market that can change very quickly based on what happens off the back of the conflict in the Middle East. I was worried about that the conditions about war changing, and therefore we could see some positivity in the markets and a drop in oil prices. So I got out of that trade, rightly, because on the Monday morning we did surge back to where entry was on the trade, and then we've come since back down and actually hit an area where I would say I would have been take profit. So had I remained patient on that trade and left it for another week, I would have hit take profit, but I got out early based on the environment we were in, and definitely happy to pocket some profits there. Trading is a bit of a hindsight sort of thing, but all in all, exited the trade at a 2-to-1 and was very happy with the result of that trade. That's my update for today. There's a few things I'm looking at for shorting. Obviously looking at the Aussie dollar for shorting, the New Zealand dollar for shorting, the euro for shorting, but we need all three of those to come up a bit in order to get triggered for a short. And I am bearish across all of the indices at this point in time, with key levels marked across the ASX 200, the Nasdaq, the S&P, and the Dow Jones. Would I take all of those trades at the same time? Absolutely not. There's a correlation risk there. So my thoughts will be I'll probably take the New Zealand dollar as my number one preference on the currency side. Second up the Aussie dollar, third up the euro. If I already get triggered on the Aussie or Kiwi first, I won't bother with the euro. And then for the indices, I'll probably take one of them. So whichever one looks the strongest, I will take, should those levels get triggered. So that's my update for this week. A little bit going on, but I will touch base with you all if any of those trades get triggered, and we will talk to you in our update next week. I hope everybody stays safe, has a good week, and remembers that this is not financial advice. This is what I'm interpreting of the market and how I will be acting. And we're using this for education and entertainment purposes. So please don't go running off and trying to activate trades that are the same as mine if you haven't done the work to understand why we're taking those trades and to support those trade ideas yourself. Once again, have a great week, and we will see you in the next one. Thank you.